The first topic we will cover on will be devoted to the overview of financial risks. And therefore, to begin with, I would like to emphasize that understanding the financial risk is really crucial for any business or, for example, financial institution. And these risks can be significantly impact on the organization's bottom line, for example, and even its survival. And it's really important to note that there are four main categories of financial risks. Those will be discussed today during the lecture. They are market risk, credit risk, liquidity risk, and operational risk. And each of these presents actually unique challenges and requires specific management strategies, as you may understand that. And therefore, let me point out that these risks are interconnected. For instance, a market downturn can increase credit risk as borrowers struggle to repay loans, for example. And that is in turn actually can create liquidity problems for banks. For example, you can remember that in 2008, there was a financial crisis that provided a stark example of how these risks, for example, can cascade through the financial system. And what began as a credit risk actually proceeded on the subprime mortgage market, quickly spread squeeze, to become, for example, a liquidity crisis and then a full-blown market crash. To put this in perspective, during the 2008 crisis, we can remember that global stock markets lost approximately $6 trillion in value in a matter of months, actually. And this may, as to me, demonstrate that potentially catastrophic impact of mismanaged financial risks is possible in the terms. And by the end of this lecture, we will actually have a solid understanding, as I expect, to these risk categories and how they impact, providing a foundation for more advanced risk management, for example, concepts. And we'll cover later that concept in the course. So the foundations of the risk management, therefore, is probability. I suggest that I expect that you are, or some of you are pretty familiar with the probability concept, but nevertheless, so we will grow through that, and I will, for those of you, for example, who are not familiar with that. Therefore, probability is a relative measure of the possibility of some event occurring. And to kick these things off, let's dive into the concept of probability, which is actually, as I said before, fundamental to understand and quantify risk. And hereby, I want to stress that the probability is not just an abstract mathematical concept, but a practical tool used daily in risk management decisions across all financial industry, actually. Then I would notice that the probability is always expressed as a number between 0 and 1, or as a percentage between, for example, 0% and 100%. And this standardization, as you may know, allows for easy comparison of different risks. For example, let us give an example of that. For example, let us consider the credit default swap, or CDS, in terms of the market, of course. The price of the CDS, for example, may reflect the market's assessment of the probability of the company defaulting on its debt. For example, in 2008, as you may remember, Lehman Brothers CDS spread. I hope you remember the Lehman Brothers case in bankruptcy. So Lehman Brothers CDS spread spiked to over 700 basis points just before its collapse, which indicated actually a very high probability of default. So therefore, the CDS spread may reflect the probability of default of the counterparty, for example. And in finance, we actually often deal with complex and multifaceted events. And the probability of these events actually occurring is calculated using sophisticated models, complex models that take into account multiple variables, usually. So therefore, probability is very important for the risk management. So what is the connection between probability and set theory? Let us delve into deeply. Let me start, for example, with saying that the connection between these two categories, probability and set theory, is not just a theoretical construct, but this is a powerful tool in risk modeling and analysis, of course. And as to me, it is crucial to understand actually that in these contexts, we're treating possible outcomes as sets within a larger space of all possible outcomes. And therefore, this allows us to apply mathematical operations to these sets, which, for example, directly correspond to probability calculations. If you'd like to remember, for example, a real-world example of that, let us consider, for example, a portfolio of stocks. In this portfolio, each stock can be thought as a set within the larger space of all possible investments throughout the market overall. And the probability, for example, here of the portfolio increasing in value may be related to the union of these sets. Therefore, and this approach is particularly useful when dealing, for example, with complex financial instruments. For instance, maybe someone of you knows about the options pricing and about the Black-Scholes model. It actually uses set theory concepts to define the probability space of possible stock price movements. Therefore, there's a connection to the stock market. And next, I would like noting that major financial institutions use these kind of concepts in their risk management systems. For example, JP Morgan. JP Morgan is one of the largest investment banking institutions in the world. It has a so-called risk matrix system, which actually became an industry standard and is actually built on this, on the base of these mathematical foundations. Therefore, the next, probability range. As you may know, as you may remember, the probability of any event may be in the range of 0 to 1. And therefore, probability is not arbitrary, as I would say. This is a fundamental principle that may underpin all of the probability theory and risk management. And here, the probability of 0 actually represents an impossible event, as you know, while a probability of 1 represents a certain event. And everything actually between these two figures represents varying degrees of likelihood. And therefore, in financial markets, we rarely deal actually with probabilities at the extremes, so 0 or 1. Even events, for example, considered certain often have a teeny probability of not occurring, so they do not have the probability equal to 1 exactly. And this is usually has to be accounted in the risk management. There are no purely certain events, yeah? And for example, we may illustrate this considering the concept of risk-free government bonds. For example, despite being considered the safest investment, because they're risk-free actually, they still carry a non-zero probability of default. For example, you may remember the Greek crisis in 2007 and 2008. So during this crisis, actually, Greek government bonds, once considered very safe, saw their prices plummet during the European debt crisis, and the probability of default increased actually dramatically. And therefore, the understanding of this range is very crucial when you interpret, for example, risk measures. For example, there is a very commonly used risk measure within risk management, which is called value at risk, or VAR. We will cover on this metric more deeply during the lecture devoted to the market risk, actually. Therefore, a value at risk metric has the confidence level or probability of 95%, which is very common. And it means actually that there is a 5% of chance or 0.05 probability of losses exceeding a certain amount of this metric, value at risk. And we have finally always remember that every risk we set in finance falls somewhere in this probability spectrum between 0 and 1. And it will actually help us to quantify and compare different risks. Sorry for interruption. I will look at the chat sometimes not to miss out your questions or notices. So everything is okay? Do you hear me? Do you see presentation? Yeah, great. Thank you. So we will go on in a moment. So any questions you have, please do not hesitate to write it in the chat. So I cannot switch to my presentation just to, that is okay. So the next slide is handling probabilities. Therefore, probabilities can be handled in the same way, for example, as the sets of which they are characterized. And it is really crucial to understand that this principle allows us to apply set theory operations to probabilities, greatly, for example, simplifying complex risk calculations. And these rules are not just theoretical, as before, but are applied daily in risk management across the financial industry, for sure. For example, let us consider the first rule, the first practical rule, which says that the probability of the reverse event, about the probability of the reverse event. And this is particularly useful actually in finance, where we are interested in the probability of an event not occurring. For example, if we know the probability of a company defaulting is 5%, we can quickly calculate the probability of not defaulting as 1 minus 5%, 100% minus 5%, which will be equal to 95% of not occurring. And if we move to the second rule, for example, about the probability of either event occurring, and which is mostly often applied in portfolio risk management, for example, then assessing the probability of either of two stocks in a portfolio declining, we need to account for the possibility of both declining stocks simultaneously. And these rules actually become especially powerful when we deal with complex financial products, for example, derivatives pricing. And if we need to calculate, for example, options, probability of options expiration, for example, say in the money, and so on. The next slide. The next concept of the probability theory is mutually exclusive events. So therefore, if events are mutually exclusive, their probability of intersection equals to 0. And I want to stress actually that understanding of mutually exclusive events is very crucial in the finance and the risk management as well. And it simplifies, because it simplifies our probability calculations. Therefore, for example, we can simply add the probabilities of individual events to get the probability of either event occurring. For example, in credit risk management, default and full repayment of a loan are mutually exclusive events. Because the probability of either occurring is simply the sum of the individual possibilities. And this concept is particularly relevant in options trading. And for instance, a call option being in the money and out of the money at the expiration are mutually exclusive events. And the probability of the option expiring either in the money or out of the money equals to 1. So therefore, it's important. The next slide. And one of the most important concepts in terms of the probability theory is independence, which is defined as the mutual distribution of independent variables, actually. And therefore, it is also very important in the risk management. What does it mean, actually? It means that independent events are those where the occurrence of one event does not affect the probability of the other. And this might be simple, actually, but it's often misunderstood or overlooked in complex financial scenarios. If we try to remember an example, then, for example, in portfolio management, we often assume the stock returns are independent of each other. And this assumption underlies actually the principle of diversification, for that for sure. And for example, in 2008 financial crisis, we could see that this assumption didn't hold, as almost all stocks crashed simultaneously. Because of that, the concept of independence is very important, but the concept of diversification is questionable nowadays. And the next concept is random variable. So I would like to focus your attention on the understanding of what is random variables are. This is very crucial as well for the risk management. What is a random variable? It is a single value. It is not a single value, sorry, but it is a function that assigns probabilities to different possible outcomes. And this concept actually is fundamental to, for example, to how we model uncertainty in finance. If we turn back to the example of the stock market, why the stock market is a very good example in that terms, because the market risk actually was the fundamental application of the risk management concepts, which was driven by JP Morgan many years ago, actually, with the evaluate risk concept. Therefore, we will turn to the stock markets very often as an example. So stock prices are classic examples of random variables in finance. For example, before the market opens, we can determine exactly what price a stock will have at the end of the day, but we can model the probabilities of different price levels for sure. And here we can point out, we should point out, that the distribution of a random variable might be a key to understanding its behavior. For instance, many financial models assume that stock returns follow a normal distribution. And that is a trade-off, one of the trade-offs in the risk management. Also, in reality, they often have fat tails, so-called called fat tails, which means that extreme events are more likely than a normal distribution that would be suggested, for example. And sophisticated, actually, financial models often involve multiple random variables, for sure. For example, if we remember Black-Scholes option pricing model, then it treats both the stock price and its volatility as random variables. The next slide. There is an example, or a few examples of random variables. For example, what is a random variable with equal probability of -1 and 1? First and foremost, this example, while simple, illustrates a key concept in probability theory and risk management, which discrete uniform distribution, so-called uniform distribution. And hereby, I would like to emphasize your attention that this type of random variable, where each outcome has an equal probability, is often used as a building block in more complex financial models. And it is really interesting, actually, that this simple model is similar to the concept of a fair coin toss, as you may know. What is a fair coin toss? It's, in terms of the probability theory, it's an action where heads and tails of the coin each have a 50% probability. And therefore, in finance, we might use such a model to represent a simplified view of whether a stock will go up or go down in a given period of time. And if we turn back to the real world example, for example, then this type of model is often used in so-called binomial option pricing models. Because in these models, the stock price is assumed to either go up or down by a certain factor, each with, for example, as it was said before, 50% probability. So the next slide is probability theory, mathematical statistics, econometrics, and even machine learning are generally deal with random events, as it may be understood. Because of that, I would like to stress that these four fields, probability theory, statistics, econometrics, and machine learning, form actually the backbone of quantitative finance and risk management. And it is really, as to me, it is really crucial to understand that while these fields all deal with randomness and uncertainty for sure, they may approach it from different angles. For example, probability theory provides the theoretical foundation, while statistics, for example, gives us tools to analyze data. And econometrics applies these tools to economic problems, and machine learning, for example, uses algorithms to find patterns in large, say, data sets. Therefore, if we turn back to the real world example, in credit risk management, for example, we might use probability theory to model the likelihood of default, statistics to analyze, for example, historical default data, and econometrics to understand how macroeconomic factors affect default rates, for example. And even machine learning, as I said, to predict which customers are most likely to default. Yeah. And all of these four fields are increasingly intertwined in modern finance, for sure. For example, many hedge funds may use machine learning algorithms that incorporate statistical and econometric concepts to make trading decisions. And it's very usual and common nowadays. So there's another example of the scoring model. Yeah. For example, if we build a scoring model on the assumption that trends that have occurred in the past will also occur in the future. First of all, this example would highlight a critical assumption which may underline many financial models. So the past trend, as I said, will continue into the future, and it is crucial. It is a very crucial assumption for the risk management. Then this assumption actually often holds and allows us to make useful predictions. But it can also lead to significant errors when the underlying conditions, for example, change dramatically. If we turn back to the example, so the credit scoring models widely used in the banks are typically built or being built on the historical data. For example, during the several few recent financial crises during the period of time, many of these models actually failed at the relationship between traditional credit factors and default risk changed dramatically. And therefore, this assumption actually is not unique just for the credit risk scoring model, but it underlies many financial tools. For example, mentioned before, evaluate risk concept, the calculations of this matrix, for example, to options pricing models may be affected with the assumption of the past dependence. And this, it is a real key to use in using these models, for example, being aware of their limitations. Therefore, according to the international financial reporting standards, it's moreover required to uncover the limitations of the risk management models used for generation of the figures and the reporting. So the next slide. So what is about this solving of uncertainty problems? To solve this kind of problems, actually, which means the choice of optimal action strategies under uncertainty, as it's maybe obvious. So first of all, I would like to stress that dealing with uncertainty is at the heart of the financial decision making, actually, and the tools mentioned here are really crucial for making informed, say, decisions in uncertain environments. And therefore, they have a few limitations, of course. For example, during the European debt crisis in 2007, 2008, policymakers had to make decisions with limited precedent. For example, here game theory was used, as I remember, to model potential outcomes of different policy choices, even considering the strategic interactions between various countries and financial institutions. So another example is, for example, from the mathematical statistics is Bayesian approach, which is particularly useful in finance, and it is used when we need to update our beliefs as new information becomes available, for example. For instance, in algorithmic trading, Bayesian methods or models are used to continuously update probability estimates of market movements based on the incoming data, on the new coming data. And the other methods like simulation models, for example, Monte Carlo simulations, therefore widely used as well in the risk management. For example, banks use these kind of methods to stress test their portfolios and under, say, various economic scenarios. So therefore, all of these methods are under the uncertainty problems. So one of the key concepts of the risk management is expected and unexpected loss. And you will get aware why a little bit later during the next lectures. But it is really crucial to understand this concept in order to understand the risk management incentives and decisions, to make risk management decisions. Hereby, the expected loss is usually treated as an average loss we anticipate over a given period of time, while unexpected loss represent the potential for losses beyond this average. Let me illustrate this with a real-world example, for example. In credit risk management, a bank might calculate an expected loss of, say, 2% on its loan portfolio, which may be based on the historical default rates, just by means of the statistical modeling. However, in severe economic downturns, this approach doesn't work at all, actually, because the market movements and the changes may be extreme. Therefore, actual losses could be much higher than 2%, as it was defined, and this potential for higher losses is captured actually by the unexpected loss modeling. And hereby, I would like to stress out that this concept directly influences how banks manage their capital, because these are the foundation of the capital allocation of the bank, for example. Therefore, expected losses are typically covered by provisions in the banking and pricing, for sure, while unexpected losses are usually covered by the bank capital, so not taking into account some very specific risks. And it's worth noting also that regulatory requirements, such as those under Basel III or Basel IV, which will be discovered further on, are largely based on these concepts. And the minimum capital requirements, for example, are designed hereby to cover unexpected losses, usually up to a certain confidence level, which may be connected to the external rating of the bank, say. So I will check up the chat if you have any questions. So I do not have any questions in the chat. Okay, everything clear? Don't you have any questions? Everything is okay with the sound and slides? Everything understood? Well, yeah. Great, thank you. So go on. So let us turn to the history of risk. What are the foundations or what are the origins of the risk management? Therefore, understanding actually of the history of risk management may provide valuable context for our current practices, and it may help actually us to appreciate how the field has evolved. And it is important to note that while the concept of risk is annulled as a human civilization, nevertheless, the formal risk management in finance is a relatively recent development, actually. It really takes shape in the latter half of the 20th century. And let us turn to the historical example. For example, one of the earliest forms of financial risk management was marine insurance in ancient times. Why? Because merchants would pay a premium to protect against the loss of their cargo at the sea. And here, it may be pointed out, actually, that the rapid evolution of risk management in recent decades, for example, has been driven by several factors, like advances in technology, the increasing complexity of financial instruments, and even lessons learned from financial crises. And as another example of the occurrence of the risk management in our real life, for example, there was a collapse of Barings Bank in 1995. As you may remember, it was one of the oldest banks in the world, an English bank, Barings Bank, and it was collapsed actually due to unauthorized trading, led to significant improvements in operational risk management practices across the financial industry. So the history of risk management may be formally divided into several steps or stages. First of these stages is risk, say 1, which means society. It is really crucial to understand that societies grew and became more complex. Formal systems of laws and regulations emerged as a way to manage societal risks. And this principle still underpins much of the financial regulation today. Let us give a historical example. For example, there was so-called the Code of Hammurabi, as you may know, which was one of the earliest non-legal codes from ancient Babylon. It included actually provisions for risk transfers in case of natural disasters, affecting debt repayments in those times. And this early form of risk management is still reflected in modern force clauses and contracts, for example. I would point out that the concept of risk transference mentioned here is or maybe still treated as a key strategy in modern financial risk management. Insurance, for example, which has its roots in these early societal risk management practices, remains, as you know, a crucial tool for managing financial risks, and one of the tools, yeah. Therefore, risk transference can be effective, or while risk transference can be effective, it doesn't reduce overall risk in the system, it just shifts it. And this became painfully clear during the few financial crises we observed before, when, for example, the extensive use of credit default swaps concentrated risk in the ways they weren't fully understood. So therefore, the risk management or the risks may usually not be very obvious. So the next stage or the next step of the risk management development was devoted to the industry risk management, or risk two. The shift from risk one to risk two stages represents actually a major evolution in the risk management thinking, moving from simple risk transfer to more sophisticated risk mitigation strategies. And hereby, I would like to emphasize that this shift was driven by the increasing complexity of businesses and the global economy, which made simple risk transfer through insurance insufficient or too costly. And if we turn to the historical example, for example, we can remember, we can mention the development of modern portfolio theory by Harry Markowitz in 1950s, which actually was a pivotal moment in this era. Why? Because it provided a framework for understanding and managing investment risk that actually went beyond simple diversification. Therefore, if we point out this period, so we could see the birth of many risk management techniques. Those are used even today. For instance, the concept of value at risk, the above mentioned, was really developed by JP Morgan in 1990s as a way to quantify market risk, for sure. And therefore, financial risks during this period, while important, sometimes led to the neglect of other types of risk. For example, operational risks are often overlooked until events like the Berenstain collapse in 1995 highlighted this important, actually. And to conclude, the risk two epoch represented a significant step forward in our ability to manage complex financial risks, but it also set the stage for even more sophisticated approaches that we'll discuss further on the risk three step of the evolution. So the next step was risk three, and it was devoted to the corporational risk management within corporations. So it actually represented a very huge shift towards a more holistic and enterprise-wide approach to risk management. And this was a really crucial development in our understanding of how risks interact within complex organizations, for example. And it is really important to stress that this evolution was largely driven by the realization that managing risks in silos was insufficient. Yeah, therefore. And after a few financial crises, and specifically 2008 crisis mentioned here by starkly demonstrated the dangers of failing to understand how different types of risk can interact and amplify each other. It was the really complex and really crucial understanding of how risk management works. As for the example, before the 2008 financial crisis, many banks managed market risk and credit risk separately. And I do remember this because I started in as a risk manager in 2002, and it was very ordinary to manage this kind of risk separately in separate divisions of the banks, for example, which did not communicate to each other even. So it's true. And however, during the crisis, decline in market values due to market risk realization led to increased defaults due to credit risk realization. So the interaction between these two types of risks became obvious. And this created actually a vicious cycle that many risk management systems failed to anticipate. And because of that, or due to that, there was a shift towards enterprise risk management, which reflected actually what was reflected in regulatory changes. For instance, the Basel III framework introduced after the financial crisis took a more comprehensive view of the bank's risks. Okay. And this, of course, played a crucial role in enabling risk-free stage, and the advanced data analytics and risk modeling techniques have made it possible to analyze and manage risks across the entire organization in ways, for example, they weren't feasible before. So, and the next step was devoted to the customer attraction. Was attracted to the customer, actually. And hereby, I would like to emphasize that these steps represented a significant shift in focus, placing the customer at the center of risk management and its considerations. And it was very crucial evolution in the approach to manage financial risk. And thereby, it is very important to understand that this shift has been driven by changing consumer expectations and technological advancements as well, and evolving regulatory landscape, for example, that increasingly prioritized consumer protection. Therefore, let us remember let's remember some example, for example, of this. There's a so-called General Data Protection Regulation, or GDPR, in the European Union that was established in 2018. And it fundamentally actually changed how companies handle customer data. And therefore, financial institutions had to revamp their data management practices to give customers more control over their personal information. And you can trust me, so being one of the employees of the Sberbank in Russia, so I remember very clearly the situation, how the customer information was treated due to even a few call-ups with the customer data leakage, as you may remember from the Sberbank environment. Therefore, it is really very important, it became very important. And this customer-centric approach to risk management is not just about compliance, but also about competitive advantage. For example, fintechs and neobanks have been successful largely because they've prioritized customer experience and data protection as well. And that is a real value. And what next? For instance, it really defined how the modern banks manage their risks nowadays. For instance, banks now need to consider reputational risk, in addition to market risk and credit risk. Those were treated as the major banking risks, for example, not just long ago, but nowadays banks need treat, for example, reputational risk as one of the major one. And customer data breaches, for example, are treated very seriously by the traditional banking institutions. So where do we go from here? The future of risk management actually, in financial terms, in terms of the financial development, is likely to be shaped by the continued technological advancement, for sure, and by evolving customer expectations. It is very crucial to understand that the increasing probability of data, portability of data, driven by the regulations like GDPR and open banking initiatives, for example, are fundamentally changing the relationship between financial institutions and their customers. And one of the forward-looking example, imagine, for example, a future where customers can easily share their financial data across institutions and allowing them to receive personalized financial product offerings, for example. And this could actually, as we can see, dramatically change how banks compete and manage their customer acquisition risk. So therefore, risk managers actually will need to balance regulatory compliance with the customer experience in ways they haven't done it before. Otherwise, while it may be complicated, or it may complicate customer acquisition or retention in the banking, it also provides opportunities, I'll say, for more sophisticated and data-driven risk assessment. So let us turn to the definitions within the risk management. So what is risk actually? Hereby, I want to focus your attention on the comprehensive definition of the risk in a financial context. What is risk? So fundamentally, actually, risk is tied to uncertainty that negatively affects the achievements of objectives. Yeah, and this definition actually underscores why risk management is so crucial in finance. It's about protecting and achieving our financial goals. So it does not relate only to corporations, but it may be even a personal risk management. So everybody has his own financial goals because of that. And for example, when a bank issues a loan, the risk isn't just the possibility of default or a negative event, in other words, but how that default might prevent the bank from achieving its probability objectives. Yeah, because the default is not a catastrophic event, for example, itself, but we have to consider actually what are the circumstances of defaults and what are the reasons of the defaults and what is the continuation of the default in terms of the financial objectives of the company, for sure. Let us consider another side of the problem, the positive uncertainty, like the possibility of the higher than expected returns, for example. It is actually not considered as a risk in this context. It's still important to manage. Yeah, and there are real returns because real examples. Because, for example, if you do not have the gain, so you may not lose anything, for example. But if you win something, for example, so you possess something that you can lose. So, and that might also be the risk that will be covered in the next lectures when we consider the counterparty risk management. And it's worth mentioning actually that this definition of risk highlights the importance of clearly defined objectives in risk management. Without, in other words, without clear objectives, it's really impossible to identify, to measure, or even to manage risks effectively. So let us consider the risk management process and what does risk management consist of. Here, I would like to stress your attention that effective risk management is a cyclical process. It's not a one-time event, actually. And this slide, as you can see, outlines the key steps in this ongoing cycle. It's really crucial to understand that each step in this process is equally important. Therefore, skipping or undervaluing any step can lead to ineffective risk management. And I should point out actually that technology here is playing an increasingly important role in each of these steps. For instance, if we use machine learning algorithm, so they are now being used for risk identification and measurement widely, allowing for more dynamic and accurate risk management. And while this cycle is generally actually applicable across different types of financial risks, so it's usual for the majority of the financial risks types, these specific tools and techniques, for example, used in each stage may vary, for sure. For example, the methods used to measure market risk are quite different from those methods used, say, for operational risk management. The next slide. How to select between the risk management methods and what are they? It is very important, actually, as you understand, to choose the right risk management method, and it is very crucial for effectively dealing with identified risks. And in this slide, you can see the four main approaches like avoid, decrease, pass it on, and accept risk due to different circumstances or origin scenarios. We have to note that this choice between these methods may depend on various factors, including the nature of the risk, the organization's risk appetite, for example, and the cost-benefit analysis of each approach. If we turn back to the example, then when faced with the risk of currency fluctuations, for example, a multinational corporation might choose to pass it on by using currency hedging instruments. However, a smaller domestic company, for example, might choose to avoid this risk altogether by only dealing in its local currency. Therefore, there is a difference depending on many circumstances, initial circumstances. And a combination of these methods is used for managing complex risk, for sure. For instance, a bank might decrease its credit risk through careful underwriting, for example, and pass on some risk through securitization and accept some risk, for example, or a portion of risk, which is remaining, for example. And the accept option, I would mention that it doesn't mean actually ignoring the risk. So you should understand. Rather, it involves consciously deciding to retain the risk and preparing for potential losses through methods like provisioning, for example, provisioning for expected losses and maintaining capital for unexpected losses, as it was said before. So the next slide. What about risk measurement approaches and risk assessment? Hereby, the importance of accurately measuring and assessing risk is very crucial. It's obvious, and here, this slide introduces key concepts in risk quantification, including, as it was mentioned before, expected loss concept and unexpected losses concept, and the value at risk concept as well. The distinction, as was said before, between expected and unexpected losses is very distinct, actually. due to expected losses are those we anticipate and can plan for, while unexpected losses in that terms represent the potential for losses beyond our expectations. If we get back to the example of the risk management, for example, in credit origination, I don't know, a bank might expect a 2% default rate on its loan portfolio, which is expected loss, but stress tests might show that in severe recession, defaults could rise to 5%, say, which is unexpected loss in that terms. And the value at risk concept, or shortly VAR, has become really a standard tool in risk management here. For example, a 1-day 90% confidence level VAR metrics of $1 million, for example, means there is a 1% chance of losing more than $1 million in a day. So that is an explanation of the concept. And however, it's important to note VAR's limitations as demonstrated during a few previous crises. So it doesn't work, for example, in terms of the normal distribution assumption. So as you can remember, and because of that, many institutions during the few crises experience losses far beyond their VAR estimates. And the model risk measurement often actually involves complex statistical models and simulations. For example, Monte Carlo simulation, which is really widely used to model potential loss distributions and calculate value at risk. As I remember, so we started in 2002, say, we started with the so-called parametric, very simple approach to the value at risk calculation. Then we proceeded on historical simulation. And now I guess that Monte Carlo simulation or even more complex approaches to simulations are widely used within banking. So the next approach is qualitative risk measurement. Let us state an example of that. It is really crucial as well, and it's a very good addition. It's an inevitable addition to the quantitative risk measurement. Actually, these two approaches are being used mutually. So this slide represents, as you can see, methods for converting qualitative assessments into a semi-quantitative score, and there is a meaning. There is a sense of this method. So we have some qualitative factors, for example, as an entrance to the model, and we try to quantify them and to derive some unified quantitative measurement of the risk at the end. Why do we need this method? We needed that because it allows for more consistent comparison and aggregation of different types of risks. For example, after 2012, as you may remember, or some of you, there was a LIBOR, so-called LIBOR scandal. So LIBOR is a very widely used measure of the average interbank rate, exchange rate. Yeah. And there was a LIBOR scandal during which many banks implemented similar scoring systems to assess and monitor their conduct risk, for example, and which is inherently qualitative, but had significant financial implications. And the weights, for example, here, and assigned to different risk factors are very crucial in this method and very challenging, because this is one of the most problems with the methods of how to define the proper weights for the measurement. On the one hand, for example, these weights should reflect the relative importance of each factor to the overall risk profile. But on the other hand, it's very complex. It's very difficult to define these weights, and because they should regularly, because of that, they should regularly be reviewed and updated. Therefore, but nevertheless, this method provides actually a structured approach to assessing qualitative risks, and it still evolves a degree of subjectivity of the risk management. These hereby the scores assigned to each indicator often rely on expert judgment and can vary between assessors, for example. So let us okay. So before we move to the typical financial group risks, we have a break. I guess for how long break do you have? So I'll check it out. I think we have a 20 minutes break. 10, yeah. It's okay because 20 minutes is too long actually. Okay, let us have a break and let us get back at 3 o'clock, actually. A break for 10 minutes. Okay, let us go on. So, is everything okay? Do you hear me? Do you see presentation? Yeah, great. Thank you. So let's go on. Okay, what are typical financial group risks? Therefore, there is such a definition like map of typical risks in the financial group, actually, and I would like to introduce you to these major types of the financial group risks. But you should understand that this set of risks actually varies company to company, for example, depending on the industry, depending on the production type, I don't know, and therefore, the majority of risks we will observe during the course will relate to the financial industry, actually. And these risks that you can see on the slide, they are not isolated at all. As I said before, so they often interact and can even amplify each other. For example, a market downturn or market risk can lead to increased defaults or credit risk realization and to potential liquidity issues, for example. That was actually observed during the crisis in 2008 when we saw how these risks interacted. So the subprime mortgage crisis, credit risk, led to a freeze in the interbank lending market liquidity risk, and to which caused a stock market crash, for example, which is market risk. So the next slides. Now let us consider very briefly credit risks. First of all, credit risks are obviously the most fundamental risk in finance, particularly for banks and lending institutions. And it is really crucial to understand its various forms and implications. So credit risks, in other words, goes beyond just the risks of default, for example. As we can see from this slide, it includes migration risk, concentration risk, and often country risk, among others, for example. And for example, during the European debt crisis, we saw how country risk and credit risk underwent. And Greek government, for example, Greek government bonds, which were issued by Greek government, once considered low risk, saw their credit ratings plummet, causing significant losses for banks and investors holding these bonds, actually. So let us consider another type of risk, which is market risk in the trading book. And there are two types of market risk, as you can see, market risk in the trading book and market risk in the banking book. For example, What is it in general? I would stress your attention that we'll delve into the market risk and the other types of risks during the next lectures more deeply, but hereby we just briefly observe them. Market risk comes in various forms, actually, as outlined in the slide. And each type of market risk requires specific management strategies and measurement techniques for sure. For example, during the Black Friday stock market crash of 1987, we saw the Dow Jones Industrial Average fall by 22%, almost 23% in a single day, which demonstrated the potential severity of the stock risk. And this event actually led to the widespread adoption of circuit breakers in stock exchanges to manage such risks. For example, and a general market risk in the trading book consists of the following risk. You can read in this slide. I will not repeat it once again, actually, as you can see it. What is market risk in the banking book, actually? Market risks in the banking book actually are often overlooked, but they have actually significant impacts on the bank's overall risk profile. And we have to note, first of all, the distinction between trading book and banking book risks. For example, while trading book risks are actively managed for profit, banking book risks otherwise are often incidental to the bank's core lending or deposit-taking activities, for example. And property risk, for example, here, as one of the part of the market risks in the banking book, for example, has become increasingly important for banks in recent years, especially after the crisis of 2008, for example, which highlighted how fluctuations in real estate values can impact both a bank's loan portfolio and its own balance sheet, for example. Another example we can remember relates to the HSBC, for instance, which with its significant presence in Hong Kong, and which had to carefully manage its exposure to fluctuations in the Hong Kong dollar. So it's an example, one of the example of forex risk, for example, in the banking book. I would stress it out. So the next one is liquidity risk. It's really the crucial concern of all of the financial institutions. I mean, liquidity risk. And it was demonstrated, actually, it was approved by the following next crises in the past, that liquidity is crucial for the banking system, especially in Russia, especially in emerging countries. Therefore, liquidity risk in this slide, as you can see in the slide, is outlined to the following types of risk. It's physical liquidity risk, it's regulatory liquidity risk, and a structural liquidity risk. And each requires different management strategies for sure. And actually, liquidity risk has become increasingly important since 2008 crisis. And now, for example, as a consequence of this crisis, there was an introduction even of the liquidity coverage ratio, or LCR, and net stable funding ratio, or NSFR, in the Basel Committee, in the Basel III specifically, which has significantly changed how banks manage their liquidity. And another example, for example, there was a collapse of Northern Rock in United Kingdom, which was largely due to the its over-reliance on short-term wholesale funding, a classic example of poor structural liquidity management. Therefore, there are actually plenty of examples of the misunderstanding and managing liquidity risk in the banking with the circumstances of bankruptcy of very old banks even. The next type is operational risks. So to kick things off, we would like to emphasize that operational risk, while often less visible than market or credit risk, for example, can be just as devastating to a financial institution. For example, it is actually the risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events even. And it is important that operational risk encompasses a wide range of potential issues, from simple human errors, for example, to complex cybersecurity threats. And this diversity actually makes it particularly challenging to manage. One of the very strict examples is an example of the Knight Capital in 2012, which was a high frequency trading firm, and it lost $440 million in just 45 minutes due to a software glitch. And this event actually highlighted the potential severity of operational risks in our increasingly so-called technology-dependent financial system. And another example is a cybersecurity risk. It really became a major concern in recent years, as you may know. For example, in 2017, Equifax data breach, it's a credit rating agency, as you may know, exposed the personal information breach or leakage of 147 million people, and it really demonstrated the potential of the reputational and financial impacts of cyber incidents. So, therefore, it's very important. And another example, say a LIBOR scandal, highlighting the importance, for example, of robust compliance frameworks, which may be a part of the operational risks, but not usually. So nowadays, compliance frameworks may be the part of the compliance risk and is treated separately. Therefore, the next is regulatory risk. So here, it really became increasingly important, actually, in the financial sector, especially since 2008 financial crisis. And therefore, the regulatory landscape is consistently evolving, and staying compliant is crucial, actually, for financial institutions. And what next about the compliance? It also actually includes the risk of changes, so regulations that could impact a firm's business model or profitability. And one of the example, for example, is the introduction of the Dodd-Frank Act in the US following the 2008 financial crisis, which led actually to significant changes in how banks operate, particularly in their trading activities. And that is why some banks had to completely restructure certain business lines to comply with the Volcker Rule, for example. And those are the examples of the regulatory risks exposure. And one of the example that I can remember, for example, it is an example of the interaction with the regulatory risk. For example, in 2014, Bank of America, as you may remember, was fined for $1.3 billion for tax fraud, which related to mortgages sold to Fannie Mae and Freddie Mac in the United States, and highlighted the potential severity of tax-related regulatory risks. So that is very important. And the other examples are related to the GDPR compliance and Dodd-Frank Act, for example. Therefore, it is very vulnerable side of the banking nowadays. And there are some specific risks actually that are not so important maybe in the risk profile, in terms of the risk profile, but nevertheless their importance evolves actually year by year. And one of them is stakeholder risk. For example, I think that it is really crucial to understand that reputational risk in that terms can arise from various sources, and it can have far-reaching consequences beyond just financial losses. It can affect, for example, a firm's ability to retain customers, to attract talent, to maintain relationships with regulators and other stakeholders. And in that terms, let me illustrate this with a real-world example. For example, in 2000, as I remember, 16, Wells Fargo Bank faced a major reputational crisis when it was revealed that employees had opened millions of unauthorized accounts. And this led not only to significant fines, but also to a long-lasting negative impact on the bank's reputation and customer trust even. So therefore, the other examples may be very specific, like social and environmental risk, which are becoming increasingly important as investors and customers become more conscious of these issues, for example. And banks financing fossil fuel projects, for example, are facing growing pressure from environmental groups and socially conscious investors. I don't know. Next type of risk is strategic, actually. It may include this type of risk you can see on the slide. I will not repeat it on once again, but I would delve into the side effects of this risk, actually. It's about the risk to a firm's or to a company's long-term success and viability, rather than to short-term financial losses. And this is a main feature of the strategic risk. And it becomes more and more important nowadays. Actually, as I know for sure that, for example, in Sberbank, they work in the strategic risk very toughly and very carefully. And this type of risk can arise from both action and inaction, which is very important. For example, making a wrong strategic decision can be as damaging as failing to make a necessary strategic change. One of the examples, very well-known examples, I would say, is a Kodak failure, to adapt to the digital photography revolution in a classic case of strategic risk. As you may remember, despite inventing the first digital camera, Kodak stuck to its traditional film business model, ultimately leading to its bankruptcy in 2012. This is one of the most obvious examples of the strategic risks failure. And therefore it's becoming more and more important, as I said. So, and we have come up actually to the first quiz. It is very short, and it will let us take for about 3 minutes to answer, to select one of the answers to this question, according to the above mentioned we discussed before. So the question is, what is the evolution of risk management approaches from risk 1 to risk 4, according to the above mentioned papers, materials? So you have to select one of the answers, and please write down your answer or your number into the chat. So it will not be evaluated at all, so don't worry about that. It just to warm up, and it just to work with the mechanism of answering the further quizzes. So please take 3 minutes to write down your answer. I will process all of your answers afterwards, just to track your interaction and to track your activity. But it is not evaluated, once again. Yeah, so I can see. Yeah, thank you very much. So yeah, you're quite right. So those of you are not in time, so you can proceed on. I will track it afterwards, but yeah, this answer is right. The evolution from social risk transfer to industry specific and to enterprise-wide approaches, and therefore we will have these type of quizzes after each topic we cover. So the next topic is risk management framework and process. Actually, just give me a half of the minute actually to proceed on. Okay, just one more check. So do I hear me well? Everything okay? Do you see slides? Do you hear me well? Yeah, great. Thank you very much for your feedback. So let's go on. So now we are going to discover the risk management framework and process very briefly. And I will focus that we will cover it on during the consideration of each risk separately afterwards. So first of all, what is risk management? Risk management is a very crucial process for the organization, for sure, and it is really a process to identify, measure, monitor, and control the various risks they face, the organizations face. And it is really important to know that business is inherently complex and anchored to so many very uncertain processes and factors. And whereas the complexity, there is a risk, actually. So let us consider a pharmaceutical industry, for example. When developing a new drug, companies face numerous risks, from unexpected side effects in clinical trials to regulatory hurdles and even market competition. And a well-implemented risk management process helps these types of companies navigate these challenges. And that is about risk management. And it's worth also mentioning that business managers often find themselves juggling multiple decisions in circumstances of limited resources and competing priorities, all while considering various environmental factors. And this juggling act itself introduces risk as well. But internal risk, for example, there are several types of risk in terms of the origination, internal and external also. So what are the objectives of the risk management? First of all, the primary objective of risk management is to identify the risks a business faces, actually. This is akin to creating a comprehensive risk map for the organization. And to illustrate this, let's consider a global supply chain, say. Here, a company might identify risks such supplier bankruptcies, geopolitical tensions affecting trade routes, or natural disasters disrupting production, for example. And by mapping this out, the company can better prepare for potential disruptions even. Moving on, once risks are identified, the next crucial step is to quantify this risk, or to assess or to measure it. And this often involves actually assigning probabilities and potential impact values to each risk. And in the financial sector, banks use usually sophisticated models to measure credit risk. The value at risk model, for example, estimates the potential loss in value of a risky asset or portfolio over a defined period of time for a given confidence interval. Yeah. And furthermore, risk management may aim to create methods to monitor risks continuously. And this is because risks are not static at all. They evolve all the time. They are really dynamic. Okay, let us proceed on the first step in the process, identification of risks. Yeah. So it is really important to understand it in this kind of process because future is inherently uncertain, as you may understand. And in every aspect of a business operation, there are variables to play with, and these variables can influence outcomes of the business of any company. For example, let us consider a technology company developing a new product. They really face risks such as unexpected technical challenges, shifts in consumer preferences, or a competitor launching a similar product first, or and to identify these potential risks on an early stage is a key really to managing them effectively. So identification is a key. Moreover, while variables can move positively here, risk management may be primarily concerned with the potential for negative movements, of course. And this really focus helps business prepare the worst case scenarios and ensure business continuity. It's worth noting actually that risk identification is not a one-time process. Of course, it's cyclical, it's dynamic, and it's continuing. For example, according to the survey of Deloitte, one of the big four consulting companies, 70% of companies that identified risk events reported that risks are emerging more rapidly than ever before. And this actually underscores the need for ongoing dynamic risk identification, for sure. Okay, and what is the measurement of risks, which is the next step in the objectives of the risk management? To start off, once risks have been identified, it's crucial to create a system through which these risks can be managed, for example, and their potential impact quantified. I would stress that this step is vital actually for prioritizing risks and allocating resources effectively, for example. For instance, in the oil and gas industry, companies use or may use sophisticated risk assessment matrices to quantify the likelihood and impact of various risks, from equipment failures, for example, to even environmental disasters, which allows actually them to focus their risk mitigation efforts where they are most needed. It's important to note, by the way, that ISO 31000 standard, which is an international standard for the risk management, or one of the standards, provides actually guidelines for creating a risk register. And this document actually is instrumental in quantifying risk values in monetary terms and identifying the likelihood of risk occurring. A study, for example, of the Ponemon Institute, so-called, found that the average cost of a data breach in 2020 was for about $4 million, just due to the data breach. By quantifying risks in this way, companies for sure can better justify investments in, for example, cybersecurity measures. The next step and the next goal is monitoring risks. So risks that are present in a business, the next risk management objective are about monitoring risks. So first of all, in reality, the probability of risk events occurring fluctuates over time, making continuous monitoring really essential part of the effective risk management. For example, let us consider a multinational corporation which operates in various countries. Political risks in these countries can change rapidly due to elections, policy shifts, or even geopolitical events. And continuous monitoring allows the company to adjust its strategies in real time, for example. Moreover, technological advancements have made risk monitoring more sophisticated than ever. And because of that, many organizations now use even artificial intelligence and machine learning algorithms to detect anomalies, for example, and predict potential risk events before they even occur. And the next step is controlling risks. After risks are identified, measured, and monitored, the final objective is to assess how these risks can be dealt with or controlled. And this is where the rubber meets the road in risk management, as we say. It is crucial to understand that risk control methods come to a cost. And this is where the concept of value at risk becomes particularly important. And the business for that purpose must carefully weight and size of the risk against the cost of controlling it to determine, for example, if it's even worthwhile managing risk. For instance, a manufacturing company might identify the risk of machine breakdown, and the cost of implementing a predictive maintenance system needs to be weighted against the potential losses from unexpected downtime. And for example, a study of McKinsey found that predictive maintenance typically reduces machine downtime by 30 to 50% and increases machine life of by 20 to 40%. That is why, moving on, it's important to note that risk is controlled throughout one of four primary methods: transferring, tolerating, treatment, and terminating. And each of these methods for sure has its place in a comprehensive risk management strategy. Therefore, transferring risk. So risk is transferred through the use of contracts such as sale or, for example, insurance contracts. So, okay, I can see, yeah, the famous quote of Donald Trump thought, use the defense secret about unknown. Risk management deals with risks if we do not even know if risk exists. There are none. Yeah. Thank you very much. So it's yeah, it's really appreciated. So I will even include this example maybe in the lecture. Thank you, Andrei. So yeah, there was a question. Let's go on. What about transferring risk? So risk transfer is one of the methods of managing risk, which often executed through contracts like insurance policies and sales agreements, for example. And this method allows business to shift some or all of the financial impact of a risk to another party, for example. Now let us consider, for example, a farmer who faces the risk of crop failure due to adverse weather conditions. For example, by purchasing crop insurance, the farmer may transfer the risk to the insurance company. And for example, in 2020, US farmers received for about $8 billion in crop insurance payouts, demonstrating the significant role of risk transfer, in agriculture. But it depends on the industry, actually. But transferring risk in agriculture is very important, one of the major methods of managing them. And it depends on the cost as well, because there is usually a trade-off between costs and benefits in managing risks. So tolerating risks, which is another example of the risk management. In some cases, actually, tolerating risk is an acceptable and even necessary part of doing business, actually. For instance, a retail business might tolerate the risk of minor shoplifting, because it's very usual, and because the cost of preventing all theft would be prohibitively expensive and could negatively impact the customer experience even. And there is a real statistics of the National Retail Federation of the United States, which says that retail shrinkage accounts for about 1 to 2% of sales is very usual. And this level many retailers find tolerable even. And the next method is terminating risk. It is usually known as risk avoidance, actually, and it may be the most extreme form of risk control. For example, it involves completely eliminating the activity or a condition that gives rise to the risk, for example. Eliminated condition. For instance, a company might decide to close down a factory in a politically unstable country to terminate, say, the associated political and operational risks. One of the examples we can remember is Coca-Cola's example, actually. It was a decision to exit the Indian market in 1977 due to regulatory challenges, and a classic example for risk termination. And it is really very spread out and very commonly used method of risk management. Simply terminate risk, not taking it. So once again, about the risk management steps, they are risk identification, risk appetite, consideration, business plan and strategy, and capital forecast. And this is due to the international standards of the so-called ICAP standards, internal capital assessment approach method, due to Basel regulations. We will cover on further on. Hereby, identification is very crucial, as we said before, and we will not stop on it. So a risk appetite is a new concept, so we haven't discussed before, so therefore we will have a separate topic during the lecture devoted to the risk appetite management and measurement. And therefore, just briefly, it is one of the keystones or milestones in the risk management, in the overall risk management process. And actually, risk appetite defines the amount and type of risk an organization is willing to take in pursuit of its objectives, actually. That is a definition. And for example, a conservative investment fund might have a low risk appetite, focusing on stable, low yield investments. But on the other hand, a venture capital firm would have a much higher risk appetite, accepting the possibility of significant losses, for example, even for the chance of higher returns. And therefore, so the risk appetite is not single, and uniform measures across an organization should be used for the measurement of and establishing of risk appetite. Different departments or projects may have varying risk appetites, for example, and for example, bank's retail division might have a lower risk appetite than its investment banking arm, for example. Comprehensive risk assessment. As we begin, it's crucial to understand that the step is about documenting our risk management processes for all material risk, even those that aren't capitalized. And this is an annual actual process to account on all of the comprehensive, all of the material risks actually. Now let us consider a large multinational corporation I worked with, for example, Sberbank. So they had to document their process for managing currency exchange risk, even though it wasn't directly capitalized. And this documentation provided invaluable when they faced a sudden currency crisis, for example, of their key markets. In my experience, therefore, the more effective demonstration include flow charts of risk management processes for that purposes, detailed descriptions of risk mitigation strategies, and examples of how the strategies have been applied in real-world scenarios, for example. And capital forecasts are very important for risk measurement. What is capital forecast in these terms? So we are essentially looking into the future of our capital position and capital adequacy, both from an economic and regulatory perspective. And that is about. And once I worked, for example, with a rapidly growing fintech company as a project consultant, their capital forecast revealed that they would fall short of regulatory requirements within 18 months if they continued their current growth trajectory. And this foresight allowed them to proactively raise additional capital, avoiding a potential crisis. And that is the meaning, that is the purpose of the capital forecasting for the risk management. Quantitative assessment of risks and capital requirements is another important thing. So this is where we calculate actually the economic and regulatory capital needed to cover existing risks. To illustrate this, let me share an experience from my time advising a mid-sized bank, for example, and we implemented a sophisticated value-at-risk model to quantify market risk there. And this allowed to actually the bank to optimize its capital allocation, freeing up resources for growth while still maintaining a strong risk position. And this is a key bone or backbone of the process. So to allocate capital effectively. And stress tests. So stress testing is a critical tool for assessing the impact of extreme but plausible, for example, scenarios on a bank's position, including capital portfolio and profit of loss. In that terms, I recall working with one of the banks that initially viewed stress testing as a regulatory burden. But however, when we ran a scenario simulating a major, for example, simulating a major geopolitical risk, so it revealed unexpected vulnerables in the emerging market portfolio. And that is why we need to stress test our business, our companies. So as to this company I worked for, this insight actually led to strategic rebalancing that likely saved them from significant losses during the next crucial crisis. And that is why stress tests are so important, and even they are very driven, toughly driven by the regulators in each country I know, where there is a banking or financial system, for example. And capital planning, of course, is very crucial. And usually in the banking, by developing a robust capital strategy that is considered both economic and regulatory capital forecast, many banks are able to, by means any bank are able to confidently expand into new markets while maintaining strong capital ratios. And so this strategic approach may lead up to 20%, for example, of increase in market share over the 3 years. So as you may know, banks are very strictly linked to their capital available, and therefore they cannot increase their business portfolio, their loan portfolio, without caring about the capital sufficiency or capital adequacy. Therefore, capital planning is very crucial. Okay, the next is risk-based decision making. What is risk-based decision making in general sense? First of all, it is important to recognize that this approach fundamentally transforms how organizations operate and make strategic choices. You may know about so-called data-driven organizations or risk-driven organizations or a company-wide risk-based decision-making approach, and therefore. So that is about the very developed or advanced organizations. And that is actually nowadays, that is completely required by the company to be risk-oriented or risk-driven. So let us consider one of the examples of the global manufacturing company. For example, by implementing a risk-based decision-making framework, they were able to optimize their supply chain, reducing cost by 15%, while simultaneously improving resilience against disruptions. This is one of the possible virtual examples of the risk-based decision making within the company. And this approach actually encompasses a wide range of capabilities for the company. For example, from high-level analytical frameworks to operational tools like risk scoring methods. And here, the key here is to ensure that all decisions are made with a clear understanding of the associated risks and potential rewards. One fascinating aspect of risk-based decision-making is how it can be revealed or how it can reveal actually hidden opportunities. For instance, I've seen companies identify new market segments or product innovations by systematically evaluating risks that their competitors were avoiding. Yeah, even. What are the benefits of risk-based decision making, therefore? Just briefly, so while I've been working within different industries, actually I've observed that regulators are often the first to benefit here. For example, by focusing on the highest risks, they can allocate their limited resources more effectively. And for instance, in a food safety sphere, regulator who implemented risk-based decision making for the regulation purposes, of course, may result in the huge increase of their efficiency. Okay, decision making choices. It is very crucial in terms of competing, in terms of competition on the market, and let us imagine, for example, any kind of company, for example, a renewable energy company. So they may face with the choice of investing in wind or solar technology. Yeah, and here each option may have its own set of technical, environmental, and financial constraints, and hereby, by systematically evaluating these factors, the company may be able to make a decision that has not only met their business objectives, but also, for example, align with their sustainability goals. So, and moreover, when making decisions, we might consider multiple factors, for example, social, technical, I don't know, business, safety, and environmental requirements, and so on. And it may be like solving a complex puzzle where each piece represents a different stakeholder or an objective. So decision-making process steps then. Risk-based actually decision making aligns with traditional decision-making steps in the following way. So in terms of the risk-based decision making in various organizations, so I think that they align with the core steps with the general risk management process. So they remain the same: define the issues, examine the options, and implement the decision. So the approach for each chapter is significantly more structured and risk aware. But RBDM, on the contrary, encourages a comprehensive risk assessment. So comparing to the simple risk management process. So there are different sources of change for which generates usually the reaction of the risk management system, like statutory requirements, like internal reviews, like lessons learned, audit findings, and so on. In that terms, there is a so-called concept of 4Ts, yeah, which is a concept of the responsive strategy in the risk management. So, and 4Ts means terminate, treat, tolerate, transfer, and it corresponds to the risk management methods. Actually, what are the challenges in the risk-based decision making? Therefore, one of the most common challenges here is actually ensuring that all options have been properly selected and defined. And now, for example, let us take an example of the retailer, for example, who initially overlooked the option of partnering with a tech company for their e-commerce expansion, which turned out to be the more successful strategy, for example, and set an assessment criteria and determining the relative importance of different objectives can also be trickier in their terms. For example, I've seen organizations actually struggling to balance shortage and in the meaning of their short-term financial goals and their and correspondence to their long-term sustainability objectives, for example. And identifying and quantifying risks may be another area where organizations often face difficulties. For instance, one energy company that initially underestimated the reputational risks associated with their fossil fuel investments. It may be one of the examples of the challenges in the risk-based decision-making. Okay, and the next is common features of effective risk-based decision-making. First of all, successful RBDM process incorporates a framework for including societal values and concerns, also included into the risk-based decisions. So, for example, in pharmaceutical company, there might be an active engagement of patient advocacy groups and their drug development decisions, which leads to more socially responsible and ultimately more successful products. So that may be one of the reasons to partner with the clients. And another crucial feature may be developing or ability to develop the plan and take risk-based decisions for the long term. For example, say energy company that may use our BDM to guide their 30 years transition plan towards renewable source, for example. So, and there is another quiz, a very short quiz. We have a couple of minutes to answer. So, according to the 4T risk management concept, please draw down which is not the risk response strategy according to this concept in the risk-based decision making. So, and please, if it's possible, state why your answer is this. So 1, 2, 3, 4. Just write down an answer number and state why you think so. So let us take a couple of minutes. Okay, let's go on. Yeah, the number 4 is right, actually, and why? Correct here. Yeah, thank you very much. I will track your activity. Why 4 is right? It is transform, actually, but the actual 4T's concept consists of terminate, treat, tolerate, and transfer. So transform is not the part of this framework. Okay, thank you very much for your answers, and we will go on. Okay, the next topic is risk governance and enterprise-wide risk management, or ERM concept. First of all, let us talk about the risk regulation. So maybe you heard about, or for sure you heard about the Basel Committee on the Banking Supervision under the International Bank of Settlements, or Bank of International Settlements, BIS. So therefore, I would like to provide some historical context for the Basel Committee on the banking supervision. First of all, the committee was established in 1974 in response to several significant events in the global financial system. And importantly, actually, that the collapse of the Bretton Woods system in the early of 1970s led to floating exchange rates and the development of currency trading as a new financial activity. Before the collapse of the Bretton Woods, the exchange rates were fixed and related to gold prices, yeah, as you may remember. And after that, they became flexible. And this for sure increased volatility and risk in the banking sector. And in 1974, the bankruptcy of Herstatt Bank in Germany had a major actually impact on the global financial system because it was due to the flexible forex rates, actually. And this event actually highlighted the need for improved international banking supervision and cooperation. And as you understand, as a result of this, the Basel Committee was formed by the central bank governors of the G10 countries. First of all, the committee held its first meeting in 1975 to begin developing common standards for banking regulation. And over the decades since, the Basel Committee has become the primary international body for development of the global banking standards and regulations, and even now. What is Basel Committee today? Here on the picture on the right, you can see the head office of the Basel Committee in Basel, Switzerland. And this is actually today the key international body for developing banking regulatory standards, building on its long history. And it is notably actually that the committee's primary objectives are to implement uniform global banking standards, for example, ensure the stability and reliability of the international banking system, and even promote fair competition between internationally active banks. And I would add that it's important to recognize that the committee now includes for about 30 members in different jurisdictions, representing actually the world's major financial centers and emerging economies. Yeah, and the broad membership here enhances its global influence and perspective. As I remember, the committee meets 4 times per year to discuss regulatory issues and develop new standards. And these meetings allow for ongoing refinement of the regulatory framework. So the next slide. What is the evolution of the Basel requirements, therefore? Now let's examine this. The Basel requirements actually have evolved over time to address changing risks and regulatory needs in the banking sector. And it is remarkable that Basel I, which was introduced in 1988, focused on the establishing minimum capital requirements just to ensure a bank's financial stability. And it primarily addressed credit risk and set an 8% minimum capital ratio, which was called Cook ratio. So moving to Basel II in 2000, in 2004, we can see a shift towards improving banks' risk management culture, and it really introduced the three-pillar approach of minimum capital requirements, supervisory review, and market discipline. And in Basel III, the next step, it was developed in response to the crisis of 2008 financial crisis. It aimed actually to strengthen the financial system resilience. And key changes included higher capital requirements, new liquidity ratios, and additional capital buffers. And it is interestingly that Basel IV focuses on reducing systematic risk and standardizing risk measurement approaches across banks, which aims actually to increase comparability and reduce reliance on internal models. So that is about the Basel evolution. What is capital adequacy? What is capital adequacy? I would say concept. Yeah. Importantly, that these ratios within capital adequacy measurement compare a bank's capital to its risk-weighted assets, or RWA. The higher the ratio of capital adequacy, therefore, the more capable a bank is in terms of absorbing potential losses. Yeah. There are three capital adequacy ratios. The Common Equity Tier 1, or CET1 ratio, which is a Tier 1 capital ratio, and the total capital ratio. Yeah. Each of these ratios has different minimum requirements set by different local regulations in different countries. For instance, under Basel III, the minimum CET1, Common Equity Tier 1, is 4.5%. Yeah, the Tier 1, the next ratio is 6%. And the total capital ratio is 8%. So they're different. And many regulators set high requirements for their national banks. This is the most usually used approach by the regulators. So what is a three-pillar model in terms of the Basel regulation or Basel recommendations? It was first of all introduced by the Basel II, and it really remains nowadays a fundamental framework in banking regulation. Pillar 1 here focuses on minimum capital requirements for credit, market, and operational risks. And it provides actually specific methodologies for calculating those requirements. And in Pillar 2, Pillar 2 addresses actually the supervisory review process, and it includes banks' internal capital adequacy assessment processes, so-called ICAAP process. And also regulators' evaluation of these processes. And Pillar 3, what about Pillar 3? Here we see a focus on market discipline, especially through enhancing of disclosure requirements. This actually aims to improve transparency and allow market participants to better assess a bank's risk profile. Yeah. Okay, let us delve into Pillar 1. So I can see. Oh, it's an answer. I thought it's a question. So I would remind you once again that if you have any questions, please do not hesitate to write it down into the chat. So, and we are going on. Sorry. So minimum capital requirements due to the component 1 of Pillar 1. It focuses on the minimum capital requirements for the bank, and the component actually defines different tiers of capital, with a common equity tier, which is the highest, maybe of the, or must be, or has to be of the highest quality. And it includes actually common shares and retained earnings. We should note that additional tier one capital includes instruments like, or may include instruments like perpetual subordinated debt, for example, while tier two capital can include term subordinated debt and certain loan loss provisions, for example. For instance, under Basel III, banks are usually required to maintain a minimum CET1 ratio of 4.5, a tier one capital ratio of 6, and total capital ratio of 8 of risk weighted, or comparing to the risk weighted assets. Okay, and according to Pillar 1, there is so-called internal ratings-based approach. It's a more advanced approach, which allows banks to use their own internal models, for example, for calculating regulatory capital requirements. In general, IRB approach requires banks to estimate the key risk parameters such as probability of default, loss given default, and exposure default in terms of the credit risk management. And there are the others, more simple approaches for the capital adequacy estimation. Actually, they are called standardized approach and foundation approach. But we are not going to consider them because they are not such interesting in terms of the risk management, because they just have the fixed ratios for capital allocation. Yeah. And therefore, the most interesting approach for us in terms of the risk management is internal ratings-based approach, and we will focus on this approach later on. Implementing of the IRB approach actually involves a complex process, including data collection, model development, validation, and ongoing monitoring. So here is an RWA calculation example. While Basel framework provides different approaches for calculating risk-weighted assets, which is a base of the capital adequacy concept, particularly for the credit risk, but these approaches range from the standardized approach to more advanced internal ratings-based approach, and each offer different levels of risk sensitivity and complexity. And it is very important to understand that the standardized approach uses predefined risk weights assigned by the regulators, making it simpler but less risk sensitive, actually. Moving to the IRB approaches, we can see banks using their own internal models to estimate risk parameters like probability of default and loss given default, LGD. And this allows a more precise risk management, a more precise and more flexible, I would say, risk adequacy measurement. But it is very interesting to notice that while advanced approaches generally lead to lower capital requirements, they also require sophisticated risk management systems and regulatory approval. So it's not a very, it's a very complex process of getting your internal based rating system or internal based model system risk management being approved. So the next pillar, the next capital of the Basel II is ICAP, internal capital assessment approach, which is one of the key elements of the Basel II, and it requires banks to have a comprehensive process for assessing their overall capital adequacy in relation to their risk profile. So while the previous component, Pillar 1, was about measuring capital adequacy, Pillar 2 is more about the processes of measuring capital adequacy. So what is the difference between regulatory capital and economic capital? As you can see here in the slide, regulatory capital actually is determined by regulatory requirements and formulas, while economic capital is based on the bank's own assessment of the capital need to cover potential risks or potential losses. It is important to understand actually that regulatory capital aims to ensure a minimum level of solvency across the banking system, while economic capital is tailored to the bank's specific risk profile and risk appetite. So regulatory capital is an average through the banking system, while economic capital is very specific to a definite bank. Moving on to the calculation methods, we can see that the regulatory capital is typically based on standardized approaches or improved internal models, while economic capital often uses more sophisticated or bank-specific models. So that is a difference. Okay, and the final element of the Basel II and Basel III, therefore, is market discipline, Pillar 3. I think this is obvious. This is about reporting, actually. So first pillar is about measuring, second pillar is about processing, and pillar 3 is about reporting or disclosure. Let us move to the integrated risk management, the next topic within the lecture. So, what are the major risk management principles in terms of the enterprise-wide risk management? There are several of them, actually. One key principle is risk awareness. It involves actually fostering a culture where all employees understand and consider risk in their daily activities. The next principle is risk limitation. Yeah, it really involves setting clear risk appetite statements and implementing a system of limits to ensure risks remain within acceptable bounds, for example. The next principle of continuous improvement of the risk management, we can see as for these methods, we can see that effective risk management requires ongoing refinement of methods, processes, and systems to address evolving risk and regulatory requirements. And the next principle may be the principle of separation of duties in crucial banking processes of risk management. This may involve, for example, ensuring that risk-taking functions are not separate are separate from risk management and control functions. So these are, and decentralization, centralization as well, and risk-based operations as well. So several key principles. What is corporate governance system in terms of the risk management? And what are risk management committees? So hereby, I would like to highlight actually the role of risk management committees in the corporate governance structure of financial institutions. And it is notably that committees typically operate at this executive level and focus on specific risk types or areas such as credit risk, market risk, or operational risk. There are specific committees for each type of the major risks, actually. I mean, credit risk committee, market risk committee, asset and liability management risk committee, or Asset and Liability Management Committee simply. And all of these committees actually often have authorities to approve risk limits, review risk reports, make risk decisions on any risk-related issues, and so on. The next concept is 3 lines of defense, actually. What is 3 lines of defense on these terms? It means distribution of functions between units. Let's begin by examining the 3 lines of defense model hereby, which is a widely adopted framework for organizing risk management and control functions in financial institutions. That is very important, that the first line of defense consists of business units that own and manage risks. And therefore, they are very responsible for identifying, assessing, and controlling risks in their daily operations. And it really worth noting that the second line of defense includes independent risk management and compliance functions. They usually provide oversight, set policies, and monitor the first line's adherence to risk limits and controls. For example, the Credit Risk Management Department reviewing and challenging loan proposals from business units would be part of the second line of defense. And the third line of defense is internal audit hereby, and it usually provides independent assurance of the effectiveness of governance, risk management, and internal controls. Yeah. And there is a fourth line of defense, but it's not usually shown. It means regulatory and external audit. Yeah, but it's beyond the bank itself. What is an integrated risk management process? Therefore, so it is very crucial, of course, for effective enterprise-wide risk management. And it begins actually with the identification and assessment of all material risks faced by the institution. And it goes beyond traditional financial risks to include operational, strategic, and reputational risks as well. Then on the next step, it involves aggregating these risks to get a comprehensive view of the institution's risk profile, and this often involves sophisticated risk models and stress testing, for example. Moving on to the risk appetite here, we can see the institutions, that institution needs to define their overall risk appetite and cascade it down to specific risk limits for different business units and risk types. And the process here doesn't end with certain limits, of course. So continuous monitoring and reporting are essential here to ensure the institution stays within its defined risk appetite. What are the difference in that terms of the economic capital and so-called available financial resources, or AFR? Let us discuss the concept of economic capital and available financial resources. And you may remember the difference between economic capital and regulatory capital. Yeah. So economic capital is an internally estimated value of the capital which may be allocated to the risks the bank takes, for example. But what is an available financial resources? It's a more tough estimate of the economic capital, actually. It's more about liquidity, liquid resources that those can be forwarded, for example, or allocated to the proper business operations. So, while economic capital may include, for example, not just money or liquid debts, liquid fixed incomes or liquid assets. It may include, for example, real estate, which may not be liquid, and so on. But available financial resources is usually about the liquidity as well. And stress testing is a very important process of the overall risk management. So stress testing goals, therefore, are about evaluating the potential impact of exceptional but plausible adverse events on the bank's financial condition. And therefore, we will cover it up by the next topics. So there are several general approaches to the stress testing, which are like sensitivity analysis, scenario analysis, and reverse stress testing. Which of these approaches offers different insights into an institution's risk profile, actually. And RAROC, a risk-adjusted return on capital concept, is very usually used in these terms. So RAROC is usually calculated by dividing risk-adjusted net income by economic capital, providing a measure of return per unit of risk. That is the meaning of RAROC. But don't worry, we will cover it up in the next days. But the major key to understand the concept of RAROC is comparing it to the ROI concept. ROI is return on equity. So you can see that the difference here in the scheme, you can see that the difference is that ROI is calculated according to the regulatory or banking or book capital or balance capital or accounting or regulatory capital, while RAROC is calculated on the base of the economic capital, therefore internal assessment of the banking capital. And RAROC is calculated or includes or subtract expected losses. Therefore, the average expected credit risk or market risk or operational risk losses all along the company. That is the difference. And RAROC is very important concept of the risk management because it really helps different counterparties within the bank to coordinate their efforts very effectively and to understand each other. Due to that, RAROC is very important, and it is widely used by the not only risk management departments, but financial departments, operational departments, the other business lines. Let's talk about the very important thing, which is setting risk appetite and limits. First of all, I would like to make a short overview of the risk appetite framework. Actually, just a sec. Risk appetite actually may be defined with quantitative and qualitative criteria as well. Let's start by pointing out that this slide, for example, that you can see on the screen, illustrates how risk appetite is broken down into various components and levels within the some imaginative organization company. Here at the top level, we can see the group, financial group or a group of companies risk appetite. And it may be defined actually using both quantitative and qualitative criteria. For example, a bank might set a quantitative target for its capital adequacy ratio, and this may also include qualitative statements about its, for example, risk culture, I don't know, or any qualitative information about its operational activities, for example, reputation. Here it is worth noting that these high-level metrics within risk appetite may usually be called level 1 metrics. And they usually provide a very broad view on the company's risk profile. Let us make an example. For example, an international bank like HSBC. So they usually publicly, and not only HSBC, but any international bank, they publicly disclose its core tier 1 capital ratio target as part of its risk appetite statement. And if you look for any financial statements or regulatory reporting of any internationally recognized bank, then you will be able for sure to find a part of this report devoted to the risk appetite. Moving down the hierarchy, here we can see how the risk appetite is allocated across different risk types. For example, credit risk, market risk, operational risk, and so on. And to be honest, this allocation is crucial for maintaining a balanced risk profile, for example. And as another example, a diversified financial institution might allocate for about 50% of its risk appetite to credit risk, usually on average, and 30% to market risk, and for about 20% to operational risk. That is a risk appetite usual allocation through the market. And on the next level, we can see how risk appetite is cascaded down the global business lines and legal entities, if they are within the banking group, for example. This ensures actually that each part of the organization of the bank, for example, operates within the overall risk appetite. And here it is possible to emphasize that this hierarchical approach allows for consistent risk management across the any organization, but it still provides different business units to manage their specific risks within the appropriate limitations. That is a sense, and that is a meaning of the risk appetite in general. So the next slide, let's get down to the definition of risk appetite and risk tolerance ranges. These slides, as you can see here, presents a visual representation of risk appetite and risk tolerance ranges. Here is an example of the risk-taking capacity, which is a ratio, which is a relation of the available financial resources to economic capital. It's one of the possible metric. So this scale may be applied to any metric or almost any metric within the company, which may be calculated, quantified. And here it is important to understand that these ranges are not arbitrary. What does it mean? It means that they are carefully defined based on the organization's risk strategy and regulatory requirements. For instance, many banks may set their minimum capital ratios well above regulatory minimums, for example, to provide a buffer, to provide a reserve against possible stress on the market. And if we look at the diagram, we can see four distinct zones here at the upper side of the diagram. And no-go zone usually represents a level of risk that threatens the organization's survival. For example, if a bank's capital ratio falls below regulatory minimums, it could face severe consequences, including even potential closure or bankruptcy. If you move to the right, to the left, then we have a stress zone or warning zone. And this is a very crucial area for risk managers. It usually indicates that while the organization isn't immediately in danger, but we will have to perform some corrective actions, and they're needed usually. And in practice, this might trigger actions like, for example, reducing risk exposures or raising additional capital. And the normal zone usually represents the organization's actual risk appetite. And this is where the organization aims to operate under normal conditions. And for example, a bank might set its target capital at 12%, say, and it is well above the regulatory minimum of 8%, as you can remember. And this is a capital buffer within the allocated capital risk appetite for the capital, which is an intrinsic limitation of the bank, not driven by the regulator. And here we can point out that the target value doesn't necessarily mean the lowest risk. And here organizations usually need to take some risk to generate returns. And for instance, keeping capital ratios too high could reduce profitability and shareholders' return for sure. And therefore, banks, for example, because I've been working within banking, I know it very well. So banks usually have their own intrinsic capital allocation metrics. So let's go on. Let's talk about the risk appetite escalation process, which is very important actually as one of the major processes within banking. For example, now let's start by examining the escalation process depicted in the slide. Yeah, and it's crucial to understand that this process is designed to ensure timely and appropriate responses to potential breaches of, for example, a risk appetite. Usually the process begins with monitoring at the business unit level. For instance, in a bank, the corporate lending department might notice an increase in non-performing loans approaching the risk appetite trigger. And if a trigger is breached, usually the escalation moves up to the central or so-called central risk management function, risk department. And this centralized approach allows for a holistic view for risks throughout the organization. For example, Citigroup has a chief risk officer who oversees all risk types globally. Here it's worth noting that usually group risk committee plays a pivotal role in this process, and they usually analyze results and provide guidelines to business units. And in practice, it might involve recommending reducing lending, for example, in certain, in certain sectors, or increased collateral requirements. And as usually as situation escalates further and breaches the no-go trigger, which is a red zone, as you may remember, then it reaches the management board level. So, and this is where usually strategic decisions are made. For instance, as you may remember, during the 2008 financial crisis, many bank boards had to make crucial and critical decisions about capital raising and asset sales. And this is a level of the management board. Also as a response to the trigger of the no-go limit, risk appetite limit breach. And here we have to say that this escalation process usually is not just about managing crisis. It's also a feedback mechanism that informs the ongoing refinement of the risk appetite framework. And regular breaches of triggers might indicate usually that the risk appetite needs to be adjusted or that business strategies need to be reconsidered. And this is a part of the regulatory reporting also. And if you breach your limits very often, so it's an obvious sign for the regulator that you have some problems. For example, they can pay much more attention to you in that case. So the next slide. Let's talk about the risk appetite restrictions. There are, for example, qualitative restrictions and management categories in that sense. And this slide outlines various qualitative restrictions and these management categories that form part of a comprehensive risk appetite framework. And it's crucial to understand for sure that these qualitative elements complement the quantitative metrics. Those have been discussed before. And these provide a more nuanced view, I would say, of an organization's risk profile. For example, if we look at the credit risk category, then we can see restrictions like the share of credit risk economic capital allocated to different portfolios. For instance, a bank might limit its exposure to the real estate sector up to, say, 20% is total credit risk of the economic capital allocated. What for? Usually for avoid, for example, over concentration of the credit risk in the portfolio. If we move to the market risk, so we can see the limits of the value at risk value and stop loss, for example. And for example, I remember that many banks learned the hard way during the 2008 crisis when it showed actually that value at risk alone is not sufficient, and which is why stress limits are also included. So have been also included into the risk reporting since that time. And if we look at the operational risk category, so we can see focus on the share of expenses related to operational risk. And this actually might be a key area for many organizations like banks. And for example, an example of this allocation is cybersecurity breaches. Those can result, for example, in significant costs and reputational damage. If we look at the ALM risks, so for asset liability management risks, they also usually include indicators like economic open forex position, for example. It is really important. It might be really important for the international banks. For instance, HSBC with a global presence usually needs to carefully manage its currency exposures. So to wrap up, here we can emphasize that qualitative restrictions and management categories as well, they both provide a framework for holistic risk management, and they both ensure that all significant risks are considered and managed within the organization's overall risk appetite. So the next slide is integrating risk appetite. So let's talk about the way how to establish risk appetite and how to integrate it into the business process. Therefore, let's start by examining the central concept of this slide, which is integrating risk appetite into the business process. And this is crucial, really crucial for effectively managing and organizations' risk profile. Here, the graph shows how various stakeholders may influence the risk appetite. And for instance, shareholders might push for higher returns, while regulators, for example, demand stronger capital buffers. And these competing interests must be balanced actually in the risk appetite framework by means of some kind of the trade-off. And it's usually important to note how the current risk profile fits into the risk appetite. For example, if a bank finds it's not performing, low ratio rising, it might adjust it to risk appetite for certain lending activities. And also here, this slide illustrates how risk appetite may impact various aspects of the business. For example, one key area of risk-based planning, and for instance, an insurance company might use its risk appetite to determine which new product lines to pursue or markets to enter, for example. Another very important area here is capital management, for sure, which is very strongly influenced by risk appetite. And here, banks, for example, use their risk appetite to guide decisions on capital allocation and across different business units. Another metric which might be shaped by risk appetite is risk-adjusted return management. And for example, many financial institutions use those metrics like RAROC, which is, as you may remember, risk-adjusted return on capital. They use them actually to ensure that they're generating appropriate returns for their risks they're taking. And here, to sum up, I should say that this process is not an ending one. It's an ongoing process. It requires actually a regular review and regular adjustment to ensure that it remains aligned with the organization's strategy and the evolving risk landscape, I would say. So the next slide. Here's an example of one of the examples of the risk appetite metrics and their limitation. So this slide, as you can see, provides a practical example of how risk appetite can be defined, for example, using specific metrics and triggers. And it's usually crucial to understand that these metrics are usually chosen to align with the organization's overall risk strategy. For example, to start with, let's look at the total capital adequacy ratio here. And here you can see that a current value of this ratio is for about 14%, which is a key regulatory metrics. And for context, many large banks aim to maintain ratios well above regulatory minimums, for example, to provide a buffer against stress scenarios. Then moving to the core Tier 1 ratio, the next one. So we can see its value up to the 10%. And it's also worth noting that this metric has gained importance since 2008 financial crisis, when regulators were focusing more on the quality of capital. Yeah. And the external credit rating target of BBB, for example, which is seen here, is interesting as well. For example, many banks set rating targets as part of their risk appetite, and usually they derive the figures for risk appetite out of the target rating, actually. As why? Because ratings are at least international ratings, they usually impact the cost of funding and ability to do business. And you know that what pain it was when um, uh, international markets in 2008 were closed for Russian banks and for Russian companies, and therefore they were forced to borrow money from the other authorities, even from the government and from the other, even from the other countries. And here to sum up and to end up, it is important to note that these examples includes both backward-looking metrics, like, for example, current capital ratios, and also forward-looking ones, like, for example, stress test results. And usually this combination provides a comprehensive view of the organization risk profile. So let's go on. What about the risk appetite hierarchy here in the slide? Now let's begin by examining how this slide illustrates the cascading of risk appetite from the overall bank level down to specific risk types and portfolios. For example, at the bank level, we can see high-level metrics like target rating, capital adequacy ratios. For example, a BBB target rating aligns for the long-term foreign currency rating of the Russian Federation, providing a benchmark for the bank's overall risk profile for the bank. This is how it is being set up, actually. And moving down to the risk type level, we can observe here how the bank's overall risk appetite may be allocated across different risk categories. For example, the slide here shows separate metrics for credit, for market, and for asset and liability management risks. For sure, this allocation helps ensure a balanced risk profile across the organization. Then we can notice the inclusion of the regulatory ratios here, like, for example, N1 as Russian normatives, actually. These usually Basel III based metrics that derive from the Basel ratios. They're really very crucial for ensuring compliance with the regulatory requirements while managing the bank's risk appetite. And usually at this portfolio level, we can see more granular metrics. For instance, in the credit risk category, there are separate economic capital allocations for corporate and for retail portfolios. Usually, this granularity allows for more precious risk management within each business line. And here, for example, an inclusion of the metrics like NPL 90 plus, which means non-performing loans over 90 days past due, and expected loss at the portfolio level is particularly important, actually, including these metrics, because they actually provide early warning indicators of potential issues in the loan portfolio. Yeah. Okay. If you do not have any questions, let's move to the next slide. And here's an example of the economic capital allocation. This slide demonstrates in particular how economic capital is maybe utilized to set limits across various risk types and business lines. And this is very important in terms of the implementation of the risk appetite framework throughout the organization. For example, this table on the left shows economic capital limits by type of risk. And we can see, for example, that credit risk has the highest allocation at 63% of the total economic value. And this usually reflects the typical risk profile of a bank. And in this typical profile, credit risk often dominates. Then it is we can note that concept of signal levels and red zones being shown on the table. For example, the credit risk signal level is set up to 67%, while the red zone starts at 812 billion rubles. This may act as an early warning indicator, for example, allowing management to take actions before limits are breached. Then we have to point out that limits are not usually static. Yeah, they should usually be reviewed regularly, and they should adjust it based on the changes in the bank's strategy, risk profile, and external environment also. And as to my experience, the high-level economic capital allocation and risk appetite are being observed once a year and being approved once a year, usually by the board of directors. Yeah, not shareholders level, by the board of directors. So let's come up to the question devoted to this part of the lecture. And you can see the question here, who will determine the bank's risk appetite? So, and the variants of the answers. So please write down your answer that it seemed to be correct, only one, in the chat, and I will observe them afterwards. So I will give you a couple of minutes for that. Yeah, that's great actually, because this answer 4 is quite right. So why? So very short description. Why board of directors is the proper authority who determine the bank's risk appetite? Because for sure, bank depositors, they have an interest in the bank, just in terms of maintaining a conservative risk profile to protect their deposits, so they may not influence the risk appetite. And bank shareholders as well, they may prefer the bank take on more risk to drive higher returns. And so it's not about the risk appetite, the limitation. Regulators, they will set guidelines usually and parameters around acceptable risk levels for the bank. But it's a general framework, not about particular risk appetite figures. Yeah, and the bank's board of directors, they're usually responsible for setting the overall risk appetite and to approving it and to overseeing risk management according to international standards, I should notice. Yeah, because there are usually some not international recognized banks, for example, regional banks and so on. Those prefer actually to set up, if they have a risk appetite figures, so they prefer to set up at the level of the management board. Yeah, but international standards usually require that bank board of directors is responsible for that figures. So any questions, please, on the topic or previous topics? So you can write them down into the chat. So I will try to reply just immediately or after the lecture.